Hey everybody, it's Wednesday, January 29th. Um, ZNTL is a really good example of how to work through a biotech trade. So what I've done is I've recreated a typical chart that most retail investors are going to see. This is just your basic candlestick chart. And this is ZNTL from December 22nd, to December 2022 through December 2023. And I've overlaid on this some of the institutional activity, like this little red dot was an offering of 424. And then these green dots were institutional purchases, and this blue dot is an institutional modification. Now, when you look at this chart, there is no information that is helpful in this chart. You could have said that when they did a dilution event that this was time to sell, but you would have had to have waited 3.5 months for that trade to work out. You could have said when a hedge fund bought in here that was a moment to buy, but the stock actually fell from $20 to $10 shortly after that. You could have bought it on the second one, and there was a little bit of a run up there. But my point is that the way that information is portrayed to retail traders is not helpful. Okay, so here is the extension of that chart. Again, there's a whole bunch of institutional modifications. The stock was fairly stable for a while, and then it fell off. There's no indication as to why it fell off, or you just said the volume. Then there's a whole lot of institutional modifications again, and then a new institutional buy-in, and then we get to today. Today is when the data came out. Now, again, this is all just random activity here. Okay, you can't draw any line on this chart that would make any sense as to what's going on. So what I've done is I've added over this all of the filings that have happened over the last year to try to give you guys a better way of understanding what happened. So there was obviously a news event that was filed in late June, and there was a news event that was filed in September. Now, I've been playing this stock for a while, so I know that this was the clinical hold, and then this was the clinical hold relief. So I know what those events are. But even knowing what the company is filing and when doesn't help you determine when to buy and when not to buy. So let's go back and let's look at ZNTL back at the time that these events happened. So the first event was in June. So let's go back here. Let's look at the late May one. Okay. So as you can see, before the clinical hold was out, the model was saying that this stock was overpriced. Okay. We like to buy from EM1 and down, right? So we wouldn't have bought the stock, even though the stock had come down from $85 all the way to $12. This stock was still not in a position with which we would have bought. Now, if you go and you look after the event, you can see that right here when the clinical hold happened, this stock fell all the way through to a position with which we would buy. And that is when we bought this stock. Now, the logic here is pretty straightforward. If you ignore the price action and you just look at this stock from a fundamental perspective, they had roughly $450 or $500 million in cash. And they just had a clinical trial because there were 2 deaths. They just had a clinical hold put on because there were 2 deaths in their trial. Now, ignoring the emotions of the fact that 2 people died in this trial, the worst case scenario is that the FDA says that none of these drug trials can proceed. That's the worst case scenario. And in the worst case scenario, this company still has $450 or $500 million in cash. And as you can see from the stoplights, no debt. That means even if the FDA shuts them down completely, this company has enough money that they can start over and buy a new drug. The only negative possibility here is a delay in that period of time. Like, that's it. Okay? The fact that there were 2 deaths is when a stock is in this position relative to the bands is not really a risk. So we bought this stock. I don't remember when, but we bought it after the event here. And then what we're doing is we're playing arbitrage on the clinical hold being lifted or on the FDA just shutting it down. Now, if the FDA shut it down, it just delays our trade for 6 months, 8 months, however long it takes out. But if the clinical hold is lifted, then what you're going to get is an elastic event, an impulse event. That's where the stock basically spikes and then comes back down. And that impulse event, I forget when it was, I think it was in September, I believe it was right here. So you can't see the intraday trading here, but the stock spiked up and came down. So what you do is you set an ask, you try to catch the spike. You basically just leave a good to cancel plus extended order on the whole time. You catch the spike. When the stock comes back down, you re-enter the position. You've either halved your cost or you've doubled your shares. This actually just happened with ALMX 2 weeks ago. There's a couple that are on clinical hold. So now you've got the stock at a really low cost. And then you can decide whether or not you want to wait out the trial results or not. Now, when the clinical hold was lifted, the FDA is basically telling you that the drug was not the cause of those deaths, which means that the odds that the company is going to report decent results is higher than what the market is putting into the stock price. Okay, so you have an asymmetric event there. Now, what happened just recently is January 9th. Let me bring up the latest chart here. Okay, January 9th, they scheduled a corporate event to present data, okay, which was what they announced today. Now, Regulation FD, Fair Disclosure Laws, requires a company to release any information that is material relevant to the stock price in a relatively short amount of time. When it comes to clinical trials, if the data is good, you have maybe 6 days, maybe 7 days. You can't hold it longer than that. If the data is bad, you have to release it much, much faster. So the fact that they told you 20 days ago that data was coming out or that they expected data to come out, that means that they had a pretty good indication that that data, when they received it, was going to be good. Okay? Now, they may not know what the actual results are, but they will know if there's been any severe events that have been reported during the trial, because this is stuff that the FDA would have been alerted on. So you had a pretty good indication that the company at least thought it was good. Now, yesterday, they announced that they were going to do a strategic reprioritization here, and they were going to lay off workers and everything else. Now, from a logical perspective, what this means is that the company's costs are going down. Whenever a company's costs go down, the value of the stock should go up. Okay, that's just simple economics. They also went through and they made a whole bunch of statements that sort of lead to the confirmation that the data was probably good. Now, emotionally, because there were 2 deaths in this trial, very, very few people would commit to this trade. Like this morning, there was very little, if any, bid pressure. There's been very little bid pressure on the stock for the last week. So it was a very, very easy short for people to hit just because there wasn't a whole lot of buying. But as soon as the data came out and it was confirmed that the death was comorbidity related to sepsis, this stock was going to take off. It was going to cover. And that is the reason why we bought the stock. We added actually to our position at 150, 148 this morning. So it's really important to understand that you can't judge a biotech based on its stock price. You actually have to model out when people are going to buy it. And that's what this ban does. This is when people are going to buy. If you had bought this anywhere else, you would be at a loss. And most hedge funds are unable to actually figure this out. That's the reason why you had these institutional purchases that were all still way down. Like, I mean, the stock's trading at $2 today, and these people were buying at 20 and whatever this comes out to be, like $12. Okay? So when you're trading biotechs, you have to remember that the price action, like this morning, ZNTL was down, I think 38% or something before the news ever came out, or well, before the full news ever came out. And that emotional reaction to that price is not going to make you a profitable biotech trader. You have to think logically. Even if the data that came out was bad, this company still, as of today, has $360 or $380 million in cash. So no matter what happens, this stock has value, considerably more value than at $1.50. So I hope that explains enough details to kind of help you work through this. And I hope it kind of shows you why looking at your typical candlestick chart, even if you put all the fundamental data on there, is not really going to help you. There are no price lines that you can draw on this chart that is going to tell you what is going on with this stock. You have to model the human behavior that is trading the stock. You have to know what people are going to do. You can snap a line on here that says, this is support at $12, or, this is now support down here at $3 or whatever. None of that matters if people aren't willing to pay the $3 or the $12 that you put your line on. You have to map human behavior and psychological response. That has nothing to do with fundamental analysis. It has nothing to do with technical analysis. You have to understand how people actually spend their own money. All right, guys, have a good day.